Welcome back. We're now in segment 7.9, and in this segment we'll be discussing about sensitivity analysis. So in the previous segment we have discussed about DSCR. We are all comfortable with the concept of DSCR. If you remember, in the DSCR calculation, in the last example we have calculated DSCR for 9 years till 2020. Okay. So from where did we get these profit figures? So we saw that the formula for DSCR is profit after tax plus depreciation plus term loan interest by term loan interest plus term loan installment. Okay, this is the formula which we use to calculate DSCR. Okay, so from where are we getting these profit figures? Right, these are nothing but from the projections submitted by the company in the CMA data. Right, in the previous example, what we did was, so we got the projections from the company. The company has submitted projections. Okay, right. So these are the projections for the next 9 years. Right, so we calculated DSCR for the first year, second year, and so on up to these are all the expected figures for the next nine years, and finally we calculated a DSCR from which we calculated the weighted average DSCR. This we did in the last segment. Okay, so basically these are projections, these are not the actual figures. So each and every item here is basically a projection, including profit after tax. What are all these projected figures? So the company is expecting a profit of this amount. Accordingly, based on that expectation, we calculated a DSCR figure. So what the company did, based on the past performance and based on its estimation of the likely business position in the future, it has come up with some projections. Now it is entirely possible that these projections are not achieved. Right, the company has given its best shot. Right, it has given its best estimate of what could be the likely future scenario and projected and prepared the financial projections. But it is possible that these projections are not achieved. Right, if that is the case, right, and say for example that profit was not achieved. Right, the company prepared a DSCR based on some projected figures, one of which is the profit figure. Right, based on some projected profitability, it has arrived at a figure of DSCR say 1.75. Now, in case this projected profitability is not achieved, right, due to some reason, in which case obviously DSCR will come down. The DSCR what originally was the company estimated 1.75 might actually come down to 1.2 or 1.1 or less than 1. We don't know. Right. And we discussed that if the DSCR becomes less than 1, the company will not be in a position to repay the installments. Okay. So if you remember our discussion on chapter 5, right, where we discussed the various items of profit and loss account, right, the profit after tax is nothing but the final figure in the P&L account. Right, in the P&L account we start with income, and then we deduct various expenses from the income and finally arrive at the profit after tax. So these expenses are various expenses. Okay, so what are the various expenses? We had raw material, power, labor, so many expenses. Right, so starting from income, which itself is a projected amount, and various expenses, all these are projections, and finally we arrive at the profit after tax. So when I'm saying that when we say that the projected profitability could not be achieved, right, what if the projected profitability could not be achieved? What we are basically saying is, what if the assumptions go wrong? Okay, so the company prepare the projections based on some estimated income. Is estimating the sales to be so and so. Right? What if the sales come down? What if the projected sales were not achieved? Then profit might come down. Or what if the company underestimated the expenses? The company has assumed some raw material rate. Cost per ton was something. Say cost of steel assumed to be 45,000 per ton, whereas actually it rose up to 50,000 per ton. Right? So if the actual scenario is in contradiction to the assumptions considered, either on the income side or on the expenses side, or either the income comes down or the expenses go up, profitability will be adversely affected, and thereby your profit will come down, and accordingly your DSCR will come down. So the projected DSCR, since DSCR is nothing but a calculated figure, there is a possibility that DSCR could not be achieved. Why DSCR could not be achieved? The assumptions underlying the preparation of financial projections might not hold good. Right? Is this point clear? If, for example, the company arrived at this profit 760, right? If you go back to our table, so maybe the company has arrived at a profit of 760, right? In the projected figures, let us assume that say 2013, 2014, 2015 up to 2018. Let us assume that how did we calculate DSCR? We calculated profit after tax, depreciation, and interest on term loan. This is the numerator, and the denominator we have term loan interest and installment. Right? Put together we have the denominator, and we calculate DSCR by numerator by denominator. This is how we calculated DSCR. If you remember the earlier segment, okay, this is how we calculated DSCR. So this profit figure, I'm speaking about this profit figure for various years. Let us assume the company has projected a uniform profit of 760 for all years, right? And I'm telling this projected profit of 760 is based on these assumptions. What are the, let us assume that profit of 760, right, was arrived based on these assumptions. Okay, so we had the sales of 2000 and rest of all expenses put together was 1240. Okay, so 2000 minus 1240, 760. This is how we arrived at the profit of 760. This is how the company arrived at the profit of 760. So the sales of 2000 was arrived, the company has assumed that it's going to sell 200 products in a year, and the sale rate was assumed at 10 rupees per product. Okay, so that is how it is arrived at sales of 2000, 200 into 10, 2000. Okay, this is the assumption. The company has projected an income of 2000 based on the assumption that it's going to, based on the assumption that one, it's going to sell 200 units. Okay, this is the first assumption. And secondly, the rate, the selling price per unit is going to be 10 rupees. Then it has assumed some expenses. Okay, the raw material, it has assumed that the number of units of raw material required is 80 and cost of each unit is 8. Okay, so correspondingly we have raw material cost of 80 into 8, 640. Then power, it has assumed that the number of units of electricity is going to be consumed is 225 per year. Okay, and the rate per unit is 4 rupees for the industrial consumers, 4 rupees per unit, so 25 to 400. Okay, then the labor expenses, it has assumed that there are going to be 20 labor that is required, so 20 number of labor are required, and salary per employee is 200, so 400. Not 200, this is 20. Okay, so this is 400. Okay, so various assumptions has gone into arriving at this profit of 760. Okay, so these are the assumptions. Okay, these are the assumptions. Please note that based on these assumptions, the company has projected a profit of 760. This is the projected P&L account, the projected P&L account, and from this projected P&L account we have calculated DSCR. Remember the DSCR calculation: PAT plus depreciation plus interest. Okay, that is the numerator, by interest and installment. That's the denominator. Numerator by denominator is the DSCR. So this projected profitability was drawn from the P&L account, projected P&L account, right? The P&L account was arrived like this. Okay, these are the assumptions. So just as this company has taken some assumptions behind the financial projections submitted to the bank, for every company, for every proposal you receive, every item in the projections will be backed by an assumption. Because these are basically estimated figures. You have to understand that this projected P&L account and the projected balance sheet are basically estimated figures. So these estimations means there has to be some assumptions. The company just cannot guess some figure and put it blindly. Okay, there has to be some basis. There has to be some assumption going into the projected financials. Okay. Now the question is, what happens if these projected figures, the actual figures, turn out to be different from the projected figures? For example, we have assumed that raw material is rupees 8, right? This is the assumption. This is the assumption which the company has prepared the projections. The cost of raw material was 8 per unit, right? What if this raw material cost, instead of 8, has jumped up to 15, right? Jumped up to 15. So what will happen by then? So what will happen? So in that case, 80 into 15 will be the raw material cost, right? This will be 1200, right? So there is a additional expenditure of 560. So if you calculate the profit, the expenses, total expenses has gone up by 560. So this will be 1800, right? Income is 2000, this is 18,000, so 200. So the profit has come down by 560. Now if you calculate the DSCR, obviously you get a lower DSCR, right? Is the DSCR still greater than 1.5? Is a question to be seen. Now I'm not saying that the company has made a wrong assumption. Please be very clear here. The company did not make a wrong assumption. See, if the company had made a wrong assumption, we could have caught it at the stage of appraisal itself. At the time of sanction, we would have caught it. If the prevailing raw material price was 15 at the time of sanction, and the company has assumed the rate of 5, we can straight away say the company has prepared a wrong projection and we have declined the projections and asked the company to submit revised projections. But this is not the case. The company didn't make a wrong assumption, right? The assumption was correct as on the date of appraisal. But subsequently, things changed. That might happen, right? Due to external factors beyond the control of the company, things turned out to be differently. On the date of sanction, it was 8. Subsequently, when it actually the project was implemented and the company was producing the products and it was selling it, the raw material has gone up to 15. Right? This is something that the company cannot do anything about. So that is what is addressed to sensitivity analysis. So sensitivity analysis, what it does, it's not to catch the mistakes in the assumptions. The assumptions are correct at the time of the preparation of the project report. These are correct assumptions. But subsequently, if the assumptions change, if the reality is different from the assumptions, how it will affect the project, right? How it will impact the project. So how sensitive is the project, right? How sensitive is the project, right? What does the term sensitive mean in normal day-to-day life? What does sensitive mean? When we say a person is sensitive, we say When we scold a person, some may cry immediately, some may just feel sad, some may be unaffected, right? Some may still laugh, not at all affected. So those people, even for a small scolding they cry, we call them sensitive. Like small input affects produces very large output, right? We are asking here, how sensitive is the project? Means for small changes in the assumptions, what is the change in the viability of the project? Viability means in the sense it's the profitability. How the profitability, how the DSCR, how the viability of the project is affected by change in the assumptions. So what we'll do in sensitivity analysis is we know what are the assumptions taken in the preparation of the projections, right? We know what are the assumptions. These assumptions are available here, right? These are the assumptions. The company has taken various assumptions. So what we'll do, we'll change we'll change some important assumptions. We'll say, okay, this and let's say the DSCR was derived at 1.75. So what we do, we slightly change, say, selling price per product. This is 10. Okay. So what if the selling price comes down to 9 or 8 or 7, and then we recalculate DSCR? Maybe the DSCR in that case may be 1.4, or we'll change the cost of raw material 8 instead of 8, 10 or 12, and then see what is the DSCR. Maybe we'll change power. What if the power company instead of 4 might charge 5 per unit or 6 per unit? So the important key assumptions will be tweaking a bit, right? We'll slightly tweak the bit. We can say what are the company is assuming is going to sell 200 units. Maybe the company might ultimately sell only 150. So what if the company sells only 150? Will the viability of the project be affected? So we'll be changing some key assumptions and see what is the impact on DSCR. Okay. So what is sensitivity analysis? We change certain key assumptions. Now what are these key assumptions? We'll see. Okay, this actually varies from project to project, and then we'll check what is the impact on DSCR. So if our DSCR, okay, if the DSCR, even after changing these assumptions, even then, if it is healthy, even if in the change scenarios the DSCR is healthy, then we conclude that the project is viable. That is what we want. But to understand, you have to appreciate the reason why we are doing this. This one, DSCR of this project is 1 point, and we spoke that DSCR should never be less than 1. Okay, because that means the company cannot pay the installments out of the profits generated. Okay, so this is the DSCR based on these assumptions. What we call as base case DSCR. Base case DSCR is the DSCR based on these original assumptions. Okay, and we never want a scenario less than 1. This is not less than 1. Okay. So the reason why we are doing is sensitivity analysis. These are basically assumptions. Okay, these are just assumptions. The company has taken the best possible estimates, right? These are the best possible estimates at the time of the preparation of the financials, but they can go wrong. But these are the best possible the company could have done. These might definitely change because we don't know what happens in the future. Now we don't want a project. The reason why we do sensitivity analysis is we don't want a project that just because some adverse event happens, like the selling price comes down or the raw material price goes up. Just because some adverse event happens, we do not want this DSCR to come down below 1. See, that is why we do sensitivity analysis. Why? We don't want the project viability, right? This is important to us. We don't want the project viability to be adversely affected. See, just because the selling price comes down to 9, if the DSCR jumps from 1.6 to 1, that is a very bad project. We don't want to be getting, as a banker, you don't want to be financing the project, because what is the guarantee that the selling price will be 10 in the future? Right? We want a healthy project. We want a robust project, right? A healthy project, right? Just like an individual is healthy. What do you mean by healthy individual? He's got a good resistance, right? His body resistance is good. When we speak of healthy individuals, we want the body resistance to be high. If he goes to a 5-star hotel, it will be the food will be cooked in very healthy conditions, right? It will be top class conditions. So he'll be healthy. But the moment he goes to a roadside dhaba and eats some food, he becomes sick. So you don't want to be that. You don't want to be that sort of individual, right? Because definitely there will be some difference in hygiene between a star hotel and the dhaba, roadside dhaba. But if the individual is so sensitive that he eats a roadside dhaba and becomes sick. He wants only he can eat only hygiene condition. His body cannot resist. His body resistance is so low, right? Cannot tolerate even small level of unhygienist. No, that is not a healthy individual. Similarly, our project, we don't want a project that is so weak. You know, we don't want a project, right, that is so sensitive to this change in assumptions. Just because there is a small change in some of these assumptions, the project viability is affected so much that Project is viability is affected so much that the company cannot repay the bank installments. We don't want that sort of project. We want a healthy project. We want a robust project, a project that can withstand the changes in assumptions. Even if this now, okay, ultimately there's a limit to everything. Maybe if the selling price falls by 50%, fine. Maybe a project becomes unviable. Maybe any project will, if there is such a drastic change in assumptions, maybe any project will become unviable. That's okay. But what I'm saying is, say for example, there's a 5% change, 5% drop in selling price, right? Or there's a 5% increase in raw material price, 5 or 10%. These are small changes. This is not a major change. It's not a 50% change. Okay. So for example, when I say 10% change, I'm saying this falls from 10 to 9. This is a very small change. Cost of unit 8 to 8.8, around 9. This is a very small change. 10% is not a big change. Okay. So I'm asking. So what we'll do is, let us change the selling price. Let us decrease the assumption of. Let us assume that the selling price is 10% lower. Selling price falls to 10% lower. That is, instead of 10 it becomes 9. And let us see the DSCR. How much it is. Let us increase the raw material price by say 10% and see what is the DSCR. In another case, let us increase both the. Let us do both. Let us in case 1 drop the selling price by 5% or 10%. Okay. In the second case, increase the raw material price by 10%. So in this case, we are keeping the raw material same and decreasing the selling price. In the second case, we are keeping the selling price same and changing the raw material. In the third case, let us do both. Selling price we drop by 10% and raw material increase by 10%. Like this, various scenarios. Power drop by 5%. Like various increase by 5%. Various scenarios. And in each scenario, check the DSCR. And if the DSCR is healthy in all the cases, right? At least if it's greater than 1, right? Then we will say. Then we say, okay, this project is not that much sensitive to change in assumptions. We want, as a banker, to be getting into those sort of projects, right? Those projects which are viable, who can withstand the changes in assumptions. Okay, you got the point. Okay, so let us take an example. So this is the original. These are the DSCR calculated as per the assumptions, original assumptions. Okay, this is what we call as base case DSCR. Okay, base case DSCR is a base case. Base case means this is the assumptions, original assumptions made by the assumed by the company. Base case, right? Let us change some of our assumptions. Okay. Let us now rework DSCR based on 3 scenarios. One, in the first case, we'll decrease sale price by 5%. In the second case, we'll increase raw material price by 5%. And the third scenario, we'll do both. We'll do both. We'll decrease the sale price by 5% and also increase the raw material price by 5%. And we'll rework this DSCR. We'll see how this DSCR of 3.25 is going to change in each of these 3 scenarios. Okay. So let us summarize the 3 scenarios. In the first scenario, that is in the base case scenario, we had a DSCR of 3.25. In the first scenario where sale price decreased by 5%, we had a DSCR of 3.07. The DSCR dropped from 3.25 to 3.07. In the second scenario where raw material price increased by 5%, DSCR dropped down from 3.25 to 2.88. And the third scenario where both sale price was decreased by 5% and raw material price was increased by 5%, we had DSCR dropping from 3.25 to 2.59. These are the 3 scenarios, and in each of these scenarios we can calculate what is the minimum DSCR and maximum DSCR, right? For example, in the third scenario, right, the average DSCR is 2.59, is the minimum 1.7, and what is the maximum? Let us ignore this first year anyway will be having a very high DSCR because the installments repayment has not yet started. Okay, so let us take this highest 4.87. So 1.7 is the lowest minimum DSCR, 4.87 is the maximum DSCR, and 2.59 is the weighted average DSCR. This is what we summarized in this table. Okay, 1.70, 4.87. This is the base case. This is the average DSCR. So in each scenario, we had average DSCR, minimum and maximum DSCR. So let us suppose that the bank's DSCR is and norm is 1.5. So now we will check whether the DSCR is comfortable in all the scenarios, right? So if you see the DSCR, it is comfortable in all the scenarios. Not only that, in no year the minimum DSCR, in no year the DSCR has fallen down to less than 1, right? So we are now satisfied about the viability of the project, right? About the viability of the project. This project can withstand changes in assumptions. We are happy about this project because the projected financials and DSCR calculation was based on certain assumptions. We tested certain different assumptions. We changed the assumptions. We decreased the sale price. We increased the raw material. We did some changes, and even then the DSCR was healthy. The DSCR did come down, but it was still above a bank norm, right? Some banks might say that the average DSCR need not be 1.5 in these scenarios. In the base case scenario, it has to be greater than 1.5. But some banks may say in these three scenarios in the sensitivity analysis, it is sufficient if it is greater than 1, maybe not 1.5, maybe 1. Even that is enough, because definitely it's going to come down. So if the base case is 1.55, you can't expect the other three scenarios to have a DSCR of 1.55 above. Okay, so maybe some banks will do this. Again, you have to check your bank guidelines. But broadly, what you have to check in the sensitivity analysis is, in no case the DSCR should fall down. No case any of these figures should be less than 1. Right? And also the minimum DSCR. In no year should the DSCR, any figure, in any year the DSCR should not be 1. Then we can say the project is viable. The project is strong enough to withstand any changes in the assumption. Now let us look at what are the points you need to look as a banker. What are the points you should be looking out for when dealing with DSCR? DSCR calculation is based on financial projections. Okay, so any projection is based on assumptions, right? So in project finance, there are various assumptions, as we have seen: selling price, raw material price, power consumption units, various assumptions. So what you have to understand is that the company which prepares these project reports, the company which prepares this projected financials, is aware of the bank norm. See, the sensitivity analysis, don't be happy, don't. If you conducted sensitivity analysis, the base case DSCR is say 1.8, and then you did a sensitivity analysis. You had in first scenario you had 1.51, second scenario 1.442, and the third scenario we had 1.17. These are the three DSCRs that are arrived. So as a banker, you saw all these are above 1, so this is a healthy project. You accept that the sensitivity analysis is satisfactory. But please note that the company is aware of this. The company is aware of the bank norms. The company will prepare projections in such a way that you will get these figures. Now it knows that you are looking, as a banker, you are looking at DSCR of greater than 1. So it will ensure that DSCR will not fall down below 1. After all, these are projected financials. The company knows what to do. So the financials estimated, the projected financials will be prepared in such a way, right, that even changes in assumptions will create a DSCR of greater than 1. So what you have to do is to critically scrutinize the assumptions made. It is not sufficient if the sensitivity analysis is satisfactory. It is bound to be satisfactory. The company will prepare the projections in such a way. So what you have to do, you have to critically examine the projections. Right? For example, if the company has assumed selling steel price of 60,000 when actually the market price is only 55,000. Right? And accordingly prepare the projections. Thereby, it is getting a healthy DSCR base case, and also sensitivity analysis is getting a healthy DSCR. Now you have to question this. Right? It is not at all the calculation part that is important. Please understand, the calculation part is not important. It is the assumptions the company has made. If you once you accept the projections, the base case projections, and if these are very high, right? Say for example, prevailing steel price is 55,000, whereas the company has assumed 60,000. If once you accept these projections, so the calculation will be as per bank norms. The company will be getting base case DSCR of greater than 1.5, and sensitivity analysis in all scenarios will get a DSCR of 1 point greater than 1. There is nothing to be surprised about it, because the company has taken an assumption. Maybe the company initially started its preparing the projected financials based on 55,000. Maybe the company has actually started by preparing the projections by taking a price of 55,000. Maybe it started like that, and then it prepared some DSCR. It got some 1.72. Then when it did the sensitivity analysis, in scenario 1 it dropped to 1.41. In the second scenario it dropped to 1.22. In the third scenario maybe it dropped down to below 1. And then the company finance people saw this. Oh, bank is not going to accept these projections. So what we do? Let us change the assumption from 55,000 to 60,000, and then they change the calculation. So based on this revised projection, revised assumption of 60,000 per ton, now they got the figure they wanted. Now the base case scenario has gone up to 1.92. The first scenario, in the sensitivity analysis, the first scenario it has come down to 1.61. Second scenario 1.42. Third scenario 1.22. Now as a banker, you see, all the bank norms are satisfied. DSCR is greater than 1 in all scenarios. Are you getting the point? So company will first of all test a realistic assumption, the correct assumption, and arrive at some figures. If they are not satisfactory, it will change the figures and take a fresh assumption till the bank norms are satisfied. So don't be surprised if the DSCR is healthy. If the sensitivity analysis is satisfactory, don't be surprised. The company will make sure that will happen. What you have to do is you have to check the assumptions, each and every assumption. As a credit officer, this is your step. This is your duty to test each and every assumption considered in preparing the financial projections. All this assumption, each and every assumption, you have to check and be satisfied that these are correct. You have to see whether the raw material price, whether the selling price the company has assumed is reasonable. Is really the prevailing market price around 10? Maybe the prevailing market price is only 8. Maybe the company has taken 10. Or is the raw material price really 8, or is it more? Maybe 9 or 10. Is really the power rate 4? Maybe industrial consumers are being charged 6 by their power companies. Why did company take only 4? Labor rate. So each and every assumptions you have to check, right? And then if you're not satisfied, you have to question and get the projections revised. Then maybe the DSCR may not be satisfactory. So as a credit officer, you have to be always be careful. Your eye when dealing with the term loan proposal, the first thing that has to do is to go to the assumption sheet. There will be a separate sheet called assumptions sheet. In a project report, this will be the page where all the assumptions are listed. When you get a term loan proposal, the first thing you have to do as a credit officer is go straight to this assumptions sheet. Check all the assumptions. Some may be not justified. Some assumptions are not justified. Maybe the company has taken assumptions just to manipulate the DSCR and get a healthy DSCR. Right? Now you can't accept it. You have to critically question each and every assumption and be satisfied that these are reasonable. Okay. One more point you have to keep in mind when dealing with DSCR is the calculation, the method of calculation. This was discussed, right? DSCR is just not the average of all DSCRs. This we discussed. It is the ratio of the numerator, that is total of paid depreciation and interest for all years, and denominator is total of interest and installment. So sometimes what companies do is they calculate average DSCR as the average of all individual DSCR. This is not wrong. This will actually give a higher DSCR. Maybe that they got a DSCR of 1.61. You are happy. The bank norm is 1.5. It is great. But maybe they calculated this in the wrong way. You have to check the method of calculation. Right? So what is the DSCR calculation? Maybe company has calculated DSCR like this. It has got some individual DSCRs. And what it did? Average DSCR, it might have calculated in the wrong way. It might have calculated 11.48 plus 3.12 plus 2.15, so on up to 5.95 divided by 9 years. This is what the company might have done, but this is absolutely wrong. We discussed this. What is the correct way to calculate DSCR? DSCR is, you have to first add up all this numerator, the total of this paid depreciation and interest. You have to add up all the numerator items, right? And so on up to 19.23. And then you have to divide this by the sum of denominator, that is term loan installment and interest. This 1.05. 5.2, right? And finally you will get the 3.23. Then you will get the average. This is the 3.25. This is the correct method. Okay. So company may have calculated it the wrong way. You have to check the method of calculation also. Then one more thing you have to be careful is, in DSCR we had a item called interest, isn't it? DSCR is profit after tax plus interest plus depreciation by interest plus installment. Okay, this is the formula. So we have an item called interest. Okay, what is this interest? You have to understand that in the profit and loss account we have an item called interest, right? In the P&L account under expenses we have various expenses, and then we have all interest. Now interest pertains to many interests. There is a term loan interest, there is an OCC interest, partners capital, the variety of interest. You have to understand that in DSCR calculation, the interest we are interested in, the interest we are focusing is only the term loan interest. Okay, please be very clear. What we are interested in is only the term loan interest. So don't pick the interest figure from the P&L. In the CMA data, we have a item called interest in P&L account. So don't pick this figure directly and dump it in DSCR. What we are interested, this interest is the sum of both OCC interest and term loan interest, right? Maybe partners interest is not clubbed here. It is clubbed under non-operating expenses, maybe. Okay. But don't take this entire interest. What we are interested is only the term loan interest. You have to find out what is the term loan interest portion out of this total interest and then put it in the DSCR calculation. Okay. So keep that in mind. Okay. One more point is, don't do a routine calculation. Okay. See, some in banks it has become very routine, the sensitivity calculation. The scenarios they consider is decrease sale price by 5%, increase raw material price by 5%. Consider a scenario where both sale prices decrease by 5% and raw material increase by 5%. But see, real sensitivity analysis is different, because in each industry there will be some specific factors. Say for example in software industry. What is the biggest expense? The HR cost. Right, the salaries are the biggest cost because the employees are the biggest assets. Such a scenario, when you are considering a proposal for software company, what you have to do is to take the labor prices. What if the labor prices go up by 5%? Because what we are doing in sensitivity analysis, we have to take those assumptions that are critical to the viability of the company, and these critical assumptions differ from industry to industry. In software industry, labor prices are critical. In case of ferroalloy units, say for example, in ferroalloy units who use this induction furnace, they are highly power intensive units. They consume power like hell. In such sort of units, even if power tariff increases by 1 rupee, say power unit increases from 5 rupees per unit to 6, that's enough to throw this units out of business, right? So in those cases you have to consider the power cost. How is the viability of the project going to be affected if the power cost increases by say 10%? So in this example, power is the important criteria. In this example, the labor prices are important. In case of hydel power plants, when you get a power project, when you're doing a proposal for a power project and the hydel power project, what is the most important factor? Rainfall. Rainfall is the most important factor, because this power plant, hydel power plant, depend on rainfall. So they assume so many centimeters of rainfall will fall in a year. Right? But what if that rainfall is not achieved? This is subject to the vagaries of nature. What if it's not achieved? So in that case you have to, in the sensitivity analysis, you have to consider scenario where rainfall is lower than the projected in the base case. So what I'm saying is, in each example, in each industry, the assumptions will vary. What are the assumptions you have to take in sensitivity analysis will vary. Don't do this routine calculation. This everyone does. Sale price decreased by 5% or 10%. Raw material increased by 5% or 10%. Or that is okay. I mean, that is one part. But please see what are the specific and critical factors in this particular industry. Right? In a particular industry where you are doing the proposal, and then consider the changes in assumption accordingly. Okay. So one more point which I need to point out here in sensitivity analysis, though it is an advanced topic, the real scenario analysis. The real scenario analysis is actually Monte Carlo simulation. Okay. So what banks are usually doing the sensitivity analysis? Decrease in sale price 5%, increase in raw material. Okay, this is a basic way. This is one way of doing sensitivity analysis, but it's a basic way. But the actual scenario analysis, what is known as scenario analysis, is basically done by what is known as simulation, Monte Carlo simulation. Actually, it is used a lot in risk management, in the area of risk management. If you are a bit statistically inclined, you have an exposure to concepts such as probability distributions and confidence intervals, these sort of stuff, then definitely you can learn Monte Carlo simulation. You require a basic understanding of probability theory. Okay, so if you are comfortable, you can definitely refer to any standard textbooks and any standard textbook on the subject and learn about simulation, because this is what actually a risk management professionals does. What we are actually doing sensitivity analysis is nothing but a risk management tool, isn't it? Right? So we are seeing what if the assumptions change. How is the project viability going to be affected? So basically, it's an exercise in risk management. So if you are interested, right, please try to learn a bit about simulation. Okay. So with this, we come to the end of the segment. This is a very important segment, sensitivity analysis. Please go through and refresh the concepts. If you are not comfortable, please review this chapter once again. Okay. So in the next segment, we'll be discussing about DSRA. Right? We'll be discussing about DSRA and asset coverage ratio. Okay. Asset coverage ratio. So don't confuse this with DSCR. DSCR is different. DSR is different. This will discuss in the next segment. Okay. So in the next segment, that is 7.10, we'll be discussing about DSR and asset coverage ratio. Right. See you then.